when we think about project finance and risk management, it's really about returns, not profits. And so that spectrum, that nice, clean, low uncertainty, low revenues, high uncertainty, high revenues, becomes a little bit more of a rainbow. I'm going to call this the return rainbow, and hopefully not get too badly made fun of for saying that. But there is this trade-off where, if we again take our kind of low uncertainty structure in this tolling agreement, you have a very small amount of profit coming to the project, but the significant amount of certainty on that profit allows the project to go to, say, a bank and size a loan to be repaid by that contracted revenue and get a large check written by the bank with very attractive terms. And so the return that Fred might be able to see after he's gotten debt on this project could be 2.5 times what he was expecting without getting leverage on his equity. If we look at the far end of the spectrum, you have so little certainty and so much downside exposure that it really challenges the ability to go out to low risk investors, whether it's debt or low risk equity, and have them invest in this project to keep Fred from having to put up $100 million check himself. And so we might only see about a 5% increase in the return that Fred can get on his investment financing this very risky project. And thinking back to our hedging strategies here, there's the potential in this middle space here to provide enough certainty to the project to improve the financing, to go out and get efficient debt or low risk equity in a way that doesn't give up all of Fred's upside, to achieve on the whole a much better outcome than either end of the spectrum. So that's really thinking about that with debt in mind. And I know that that's not the only application here. If we look at wind and solar, we've seen hundreds of billions of dollars of really low risk equity from infrastructure funds, from pension funds, flowing into wind and solar. That's expected to increase, but how do we get access to that for storage? If we think about what certainty does to the viability of a low risk equity investment, it really affects the discount rate, which investors basically apply as a hurdle based on the certainty of the cash flows coming out of these projects. And so for that tolling project, if we take the net present value of that low profit return, or excuse me, that low profit stream back to Fred's project, we might come up with about a $10 million net present value. If we look far into the spectrum, this fully merchant unhedged project, we would probably get about a $10 million NPV as well, based on a really high discount rate applied to those very uncertain revenue streams. That, however, is not equivalent. We wouldn't be able to say that, well, you can make an investment in either project and get to the same outcome, because what we see is that pools of capital are very discontinuous with respect to risk. Once we get up to a certain risk threshold, you don't just increase the cost associated with making that investment. It just becomes prohibitive, especially for the massive pools of low risk capital that have been so supportive of de-risked wind and solar projects. So this discontinuity is a big challenge for storage assets and a big opportunity when we think about how to advance efficient hedging tools. So again, just looking back at the value afforded by the right kind of hedges, we have the potential to increase threefold the equity valuation that would be applied to this hedged configuration of Fred's project. And from Fred's perspective, if he's looking to fully sell or sell down a portion of his equity, that valuation is what he's going to get paid. So this really low risk toll is significantly worse of an outcome for him if he's going out to equity markets relative to an efficiently hedged project.